a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi everyone, welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about Japanese stocks and ETFs. And the Nikkei, the Japanese stock index, closed at a 33-year high on Friday. And it's now up 18% year to date. And 33 years back, remember in 1990, Japan was the second largest economy in the world, and it looked like that it could become the largest. All cars, electronics, everything came from Japan, but things changed after that. So let's look at the reasons for the recent outperformance. Last month, Warren Buffett for Berkshire Hathaway increased its stake in Japan's trading houses. They started buying stake in Japan's 5 largest trading houses about 3 years back, and then they have increased. And in fact, Japan is Buffett's largest exposure outside of the US. And Buffett said that he likes stocks, Japanese stocks, earning yields and dividends. And in fact, the Nikkei has paid a higher dividend yield than the S&P 500 index for the last 2 years. That is according to Bloomberg. And apart from Buffett's seal of approval, there are many other factors that have led to this surge. Foreign investors have been buying Japanese stocks, and that is mainly because of the uncertainty related to the debt ceiling showdown in the US and China's weak economic recovery. But due to decades of selling of Japanese stocks, they still remain underweight Japan and could increase their holdings further. Now, talking about the geopolitical uncertainty, major chip makers, it was reported that major chip makers, including TSMC, Taiwan Semi, Samsung, Micron, and Intel, they are considering increasing their manufacturing and bringing the manufacturing back to Japan. That is mainly because of security concerns related to Taiwan and US-China trade tensions. Now, after decades of anemic economic growth and deflation, Japanese GDP finally expanded at an annualized 1.6% in the first quarter, and inflation rose at 3.5% rate in April. And the Japanese government and regulators, they have been encouraging companies to boost shareholder value. They are sitting on piles of cash. They are returning more cash to shareholders in the forms of dividends and share buybacks. And they are also planning to unwind these complex shareholding structures. Now, as global central banks have been raising rates to tame inflation, the Bank of Japan, BOJ, continues its dovish stance, and that because of that, the yen has tumbled against the dollar for the last 2 years, and this decline, this weakness in the yen, boosts the profits of Japanese exporters. That is why exporters have done quite well. So because of this strength in Japan, currency hedged ETFs have significantly outperformed the unhedged Japan funds. Now let's take a look at some ETFs. So the first one we are talking about is the most popular hedged ETF. So it takes the currency exposure out. The ticker symbol is DXJ by Wisdom Tree. It focuses on dividend-paying Japanese exporters which have benefited from yen's weakness. And these stocks are dividend-weighted in the ETF, very popular with 1.8 billion in assets and has an expense ratio of 48 basis points. To learn more about this ETF, we can go to the quote page on Zacks.com and read our research report and articles, and using the link we can go to Wisdom Tree webpage for this ETF. So Wisdom Tree has some nice research on Japan, so you can read that research and then also learn more about this ETF. Has a nice dividend yield too. And if we look at the holdings, Toyota, Mitsubishi, Sumitomo, Japan Tobacco, these are the top holdings in this ETF. The second that I'm highlighting is also a hedged ETF, slightly cheaper than the earlier one, 45 basis points, but not a lot different. Uh, Unlike DXJ, this is market cap weighted. Again, you can go to the quote page on Zacks.com, and using the link, you can go to uh, Extracker's webpage and see what this ETF holds. So you will see similar companies, slightly different weight because this is market cap weighted. Toyota, Sony, Keyence, these are the top holdings in this ETF. The third one that I'm highlighting is slightly different. This is an unhedged ETF, and this is a part of ultra cheap beta builders ETFs by JP Morgan. The ticker symbol is BBJP. Has an expense ratio of just 19 basis points, and because of the low expense ratio, it has been very popular with investors, though it launched recently compared to, it is very new compared to the other two. 7.7 billion in assets. And again, we can go to the quote page on Zacks.com and see what this ETF does, what it holds. Let's take a look at the holdings. So you will see similar companies, Toyota, Sony, Mitsubishi, Daiichi, but again, you will also get exposure to the yen in this ETF. So only if you expect the yen to rally from here, then probably this ETF is worth a look. But for most investors, it makes sense to take the currency part out and use hedged ETFs for Japan exposure. Now, on the last slide, I have the comparative performance versus the S&P 500 index. The Wisdom Tree product has done the best. It is up about 27% over the past year. And the Extracker's ETF is up about 23%. And the unhedged ETF has delivered a performance similar to the S&P 500 index, around 9%. Thanks for watching. Make sure to check out Zacks.com/promo for an interesting offer. Also, make sure to subscribe to our YouTube channel so that you do not miss anything. And I'll see you next week.